Welcome to another episode of Smart Investing with Nosa. This podcast is hosted by me, Nosakari Ugiagbe, and in today's episode, I'll be talking about the relationship between risk and returns. And I'll try to keep this as simple and straightforward as possible and break down how these two very important finance concepts interact with each other. As some of you may know, I have been writing more frequently and more seriously. So rather than posting them on my Instagram stories, I just write on the blog, nosaugiagbe.blogspot.com. And just yesterday, I secured a domain name, nosaugiagbe.com. The plan is to develop the website so I can host all of my content in one place, the blog, the podcasts, and everything else. So go check it out. In my last two articles, I wrote about mutual funds, the different types of mutual funds, how the returns to each mutual fund varies depending on the amount of risk that the assets or the pool of securities in which the mutual fund will be investing will be taking. In the last episode, I wrote about why saving your money in the bank may be bad for you, and these two topics were centered around the relationship between risk and returns. However, from my interaction with people, including comments on both articles, I figured that a lot of people did not quite grasp the relationship between risk and returns, and to some people, the best investment product is whatever investment product gives you the highest returns. So I found a lot of people who wanted to get high returns, and they also wanted capital security. So they basically want a risk-free investment product that would give them returns that were higher than they would get in the equity market. So let's start by talking about returns, and this is probably a more familiar concept than risk. So what exactly are returns? What exactly do they represent? I would say returns are basically a reward or profit from partaking in any investment venture. And there are two major types of returns, or two major components of returns associated with investment products. Together, these two items make up the total returns on any investment. They are your income, investment income, which comprises of interest and dividends, which you typically receive periodically, and capital gains, which basically means any appreciation in the value of the initial investment, excluding dividend and income and interest income. So far, I have spoken about returns from a positive point of view. Returns could also include losses. So rather than receiving dividend, you could actually incur losses on your investment. You could actually incur capital losses instead of capital gains as well. So returns comprise both gains and losses. And the returns you get on any investment are simply a compensation for you taking on the risk associated with that investment. So the investment sponsor or the company issuing that investment product or security is basically compensating you for parting ways with your money, for giving them your money, and for taking on whatever risk that venture is going to be associated with. And as you've probably heard a million times, high risk, high return. So the higher the risk associated with an investment product, the higher the expected returns, or the higher the returns that investors would expect for compensation for taking on that amount of risk. Another thing that came up during my conversation with people was the idea that a company that pays dividends regularly is a better candidate for investment purposes than a company that doesn't pay dividends. And this is not accurate. I'll talk about the importance of dividends on a different episode of the podcast, but for now, I would say this. In theory, it shouldn't matter whether a company pays dividends or not. Remember the two components of total returns to an equity investment. You have dividend income and you have capital gains. So when a company pays out cash as dividend, it is invariably reducing the amount of capital gains that would accrue to that investment. So in theory, it shouldn't matter whether a company pays dividends or not. However, this topic has been discussed extensively in the finance world for years and years. So we'll talk about the various schools of thought on a subsequent episode. Some are in favor of dividend payments, some are against it, and to others, it doesn't matter. They're simply indifferent. We would also look at how dividend payments affect the share prices of companies that pay dividends in practice. So now that we've talked about returns, we can move over to the concept of risk. What exactly does risk mean? So risk is basically the chance that the expected outcome or the expected gains from an investment will be different from the actual outcome or the actual returns paid or due to that investment. As I have said in previous episodes of the podcast, the value of a company is typically determined by estimating the future cash flows of that company or of that business or product and discounting it to today's terms. So how much will these cash flows be worth today? They are typically brought to today's terms using a discount rate. So the discount rate is whatever rate that is used in finding the present value, the value of those cash flows today. And that's what typically gives you the company of a company. That's how you get the value of a particular unit of share in any company. So the higher the certainty associated with the expected future cash flows from an investment product or from a company, the lower the risk associated with that investment product or that company, and the lower the expected returns. And it is for this reason that returns due to government bonds are typically lower than returns due to corporate bonds or bonds issued by corporate entities. So if the German government issues a bond, the risk associated with that security are typically lower than the risk associated with similar securities issued by German companies. So for example, SAP. So the chances of SAP going out of business and being unable to pay its debt are a lot higher than the chances that the German government would go out of existence. And for this reason, corporate bonds or bonds issued by companies typically attract higher expected returns than bonds issued by government entities, because corporate bonds have higher risk. So the same principle applies to securities issued by the government in most other countries. Government bonds in whatever country you live in will typically have lower risk than bonds issued by companies or private companies or even public companies in that same country. So far, I have talked about bonds, but the principle is the same for equity securities. So the relationship between risk and returns also applies to equity securities. As a matter of fact, if you ever sat in a finance or economics class, you must have heard that equity securities typically have higher risk and as a result have higher expected returns than fixed income securities. So the major reason for equity securities having higher risk is because for fixed income securities, what happens is that you basically give a company your money, let's say $100,000, with a promise that the company would pay back your $100,000 plus interest at a particular date, irrespective of the business environment, whether or not the company makes a profit, whether or not the company makes sales. When that date comes, you get your interest and you get your principal payment. For equity, it is different. So when the company doesn't make a profit, you don't get anything. When the company makes a profit, then yes, you probably will get capital gains. However, if these capital gains had already been incorporated in the valuation of the company, the share price of the company may not even increase. So, and when the company makes a loss, if the loss is higher than what was expected, then the value of your investment in that security may go down. If the company runs into financial difficulties, you may end up not even getting anything and your total investment in that company would be lost. So equity securities typically attract a lot higher risk than most fixed income securities. There are fixed income securities for maybe companies that are in distress or companies that already have a very high amount of debt that somehow exhibit return characteristics that are somewhat similar to return characteristics of equity securities. This is simply because due to the nature of their business, they are in distress or they have extremely high amounts of debt. They are considered to be very risky, more risky than the normal corporate bonds issued by companies who are in a normal going concern state or who do not have operational issues or an unhealthy amount of debt. However, we wouldn't get into this today. what you should take from this is that equity securities typically have higher risk than fixed income securities. So risk generally can be broken down into two major parts. So we have systematic risk and unsystematic risk. Systematic risk is the risk associated with the market. So the fact that you are investing in a market exposes you to systematic risk. It is a risk that you cannot really diversify. For example, I think in the last episode of the podcast, I talked about the fact that during extreme economic conditions, during economic downturns, for example, the coronavirus crisis, as we can all testify. So a lot of companies declaring losses during this period because due to the shutdown in most states, many of them are unable to produce. Demand for most goods and commodities have gone down. So most companies tend to generate losses irrespective of the industry they are in. I think there are very few industries that would boast of the coronavirus presenting an opportunity for growth, and those are probably pharmaceutical and healthcare, technology, and media. I guess the Netflixes of this world, Amazon, etc. However, for most other businesses, for most industries, the result would be different. Many of them would generate losses, many of them would struggle, and there isn't much that many of them or any of them could have done about the situation. I mean, they couldn't have protected themselves from the coronavirus crisis. So this had nothing to do with the companies individually. It had nothing to do with the management of the companies. It had nothing to do with the corporate governance of the companies or the business model of the companies. So such a risk is typically systematic and it is undiversifiable, and it is for this type of risk that you are rewarded as an investor. The other type of risk is called unsystematic risk, and this is specific risk because this is the risk associated with investing in a particular company. So this is the risk that the board of directors of the particular company may be unqualified and bad, or that the MD would appoint his son who has no interest in the business whatsoever to succeed him when he retires. Such risk is diversifiable. This risk is also the kind of risk that's associated with investing in a particular industry. So for such risk, you can diversify by investing in a different industry or investing in various industries together, such that if one industry underperforms, the outperformance or overperformance or positive performance from other industries would insulate your entire portfolio from the underperformance of one industry. So the market the market typically does not reward you for taking on unsystematic risk, because this risk can be easily diversified. So now that we've talked about risk and returns and how they are related, I would like to talk about a very practical and simple way to think about expected returns, to think about why returns on different securities may and in fact should be different, why the returns on a particular security or a particular asset class is and should be lower than the returns or expected returns for a different asset class. So there are different ways for estimating the required return on any security. For simplicity, would restrict this to fixed income and equity securities. So there is the capital asset pricing model, which is arguably the most or one of the most popular methods in practice. There's also the multi-factor model, the build-up model, and the bond plus risk premium model. Our approach during this podcast or during this episode will be loosely based on the build-up model or the bond plus risk premium model. Under this method, we'll be talking about the various types of risk or the various components of risk that an investor needs to be compensated for when investing in any given type of security. And we'll be starting with the real risk-free rate. Think about the real risk-free rate as the compensation that an investor would demand for a completely risk-free security, assuming there would be no inflation. So this is simply the compensation that an investor would demand for deferring present consumption for a future time. So rather than spending the $5,000 I saved over the last 2 months on going on vacation. Yeah, I know I can't get on any flight right now, but rather than spending that amount on something, maybe buying a new phone, buying some fancy shoes, I am deciding to invest that money. So I need to be compensated for letting go of that money or for deferring my consumption now, assuming that investment would attract no risk and assuming there would be no inflation. The amount of compensation I would need for deferring consumption for a later time within this same single period, let's say 1 year, would be the real risk-free rate. So in addition to the real risk-free rate, an investor would also need to be compensated for inflation. So the fact that 10 euros today would probably not buy me the same kilograms of potato in exactly 12 months from today demands that I be compensated for inflation, so which is basically general increase in the prices of goods and services. So most times, whenever the government of any country issues securities for a year, the rates associated with those fixed income securities are often the nominal risk-free rates. So the nominal risk-free rate is simply the real risk-free rate plus a compensation for expected inflation. If you ever wondered why government securities in countries, in emerging market economies like Nigeria, tend to pay higher interest rates than government securities issued by developed market economies like the US or Germany, there's your answer. So the rates paid by both countries, that's Nigeria versus Germany, include both a real risk-free rate and a compensation for expected inflation. So while the real risk-free rates for both countries may be comparable, not necessarily the same, the expected inflation for both countries are extremely different. So the current inflation rate in Nigeria is about 11 or 12%, whereas in Germany the inflation is currently around 2%. So for this reason, the expected returns or the nominal risk-free rate to government securities in various countries would likely differ. The next item of risk that investors typically should be compensated for is the maturity risk. So the investors will typically demand a maturity risk premium. So if you're investing in a government security that's going to last for 5 or 10 years, in addition to being compensated for deferring current consumption and for inflation, you should also be compensated for the risk associated with locking down your money for 5 years. This is particularly important because the interest rate environment could change. So interest rates could actually increase or decrease, thereby changing the value of your security. So if market conditions make the interest rates go down, you will be better off because you already invested your money at a higher interest rate. However, if interest rates go up, you will be worse off because you already locked down your money at a lower interest rate. So for this reason, investors need to be compensated for the extended maturity or duration of the security. The next component of risk that investors typically need to be compensated for is the liquidity risk or illiquidity risk. Market participants are usually more interested in certain types of securities or securities issued by certain issuers than they are in securities issued by other issuers. For example, a very large company with a long history of issuing debt securities and redeeming those securities would find that its debt securities are more liquid. There are more willing buyers for its securities in the secondary market than there would be for a company that has issued its first sets of securities in the market. So a more liquid security would attract lower liquidity risk than a less liquid security. So when you are invested in a security that's not as liquid as others, that doesn't have a very vibrant market, when you decide to sell that security before maturity, you would often need to sell at a price that is lower than the market value of that security to attract buyers to be more interested in buying from you. So for this reason, investors typically demand an additional premium when they are investing in securities that are not as liquid as other securities are. Our assumption so far has been that the securities we've been dealing with do not have a risk of default. So our assumption has been that the issuers of those securities would be willing and able to make all commitments, which are basically the interest and principal repayments as at when due, with no risk of default whatsoever. However, we know that circumstances make companies unable to meet up with their obligations from time to time, and investors need to factor in this risk when dealing with any investment product. So another risk item, or another component of risk that investors should consider, is the credit risk. And the credit risk basically considers the possibility that the investor will be unable to pay, and the extent to which the investor will be unable to pay. That's the amount of loss that the investor would incur when the issuer is unable to pay. For fixed income securities, the items mentioned so far are usually the most important considerations when determining the required return for a particular fixed income security. However, the differences between securities issued by different countries are not only driven by the fact that the different countries have different inflation rates. Different countries also have sometimes extremely different political risk as well as currency risk, and investors often need to be compensated for taking on such political and currency risk. This is often included in their expected returns through a country risk premium, and the country risk premium doesn't just apply to fixed income securities. It oftentimes also applies to equity securities, and it can be a very important a very important consideration. So in my last article on my blog, where I talked about why having your money in a bank account could be bad for you, I gave a very popular example where I talked about how a certain musician who boasted about having 30 billion naira in his account would have incurred a significant loss if he still had that money in his account today. You can check it out for context. For equity securities, the starting point is usually the yield on long-term government bonds, which mostly considers the first 3 or 4 items of risk discussed in this episode, as well as adding an equity risk premium for taking on additional risk associated with equity securities compared to fixed income securities or bonds. I talked about this at the beginning of the episode. So in addition to the items mentioned already, so for equity securities, an investor will typically take the yield on the long-term government bonds plus the equity risk premium, and add additional risk premiums for every item of additional risk that he or she would be taking up. For example, liquidity, size, currency, country, tax, and so on and so forth. Thinking about risk in this way would help you appreciate the different levels of expected returns for different securities, to help you understand why a security having a high interest rate, for example, does not necessarily mean it is a very good investment, and that even some investments that may be considered good may not be appropriate for you given your circumstances, or in particular your risk appetite. And understanding your risk appetite is one of the most fundamental considerations when devising your investment plan or strategy. To summarize today's episode, we've talked about the risk and return relationship. So we explained how the expected returns on most securities are basically derived as a compensation for different levels of risk that are associated with security. We started by talking about the real risk-free rate, which is basically a compensation for deferring current consumption for a future date. Then we talked about a compensation for expected inflation rate. So these two items together usually give us the nominal risk-free rate. And in addition to these two items, we talked about the maturity premium, which basically compensates you for your exposure to interest rate risk for holding on to an investment security for a longer period of time. And we talked about liquidity premium, which pays you for the losses you would have to incur to be able to sell an illiquid security as fast as you would like to. And we talked about the credit spread, which compensates you for the risk of the issuer of the security being unable to pay back as at when due. Then we moved on to equity risk premium, as well as other specific risk premium that you would typically, that an investor would typically require depending on the nature of the security, such as country risk, currency risk, tax risk, and so on. In the next episode, I'm going to bring everything together to show or demonstrate how the risk and return relationship, combined with your personal circumstances and situations, as well as your goals, should help you develop a long-term investment strategy, which would be the basis on which you execute your short-term or periodic investment activities. So many thanks once again for listening to the podcast, and please share this episode and other episodes with anyone who you think may benefit from the contents of this podcast. You can also check out my blog, where I write mostly about economics, finance, and investing, and share that as well with people who you think may benefit from it. It's nosaugiagbe.com. Thank you, and see you on the next one.